In this video, Kayla and I are going to be giving you a pop quiz for the MLO tests. Let's jump right in.
All right. Okay, so let's see, Lance. So first, the question I'm going to go ahead and ask you. Flood insurance must be purchased from whom?
Flood insurance must be purchased from whom? Who do you think that is? And guys, oh, by the way, we're going to read the question and then we're going to do a pause, right, for you to answer the question. And then we're going to give you the answer. All right. So yes, first question. Yes. Flood insurance must be purchased from whom? Who do you think? It's the NFIP, the National Flood Insurance Program. Kayla, what's the minimum and maximum amount of flood insurance needed?
The minimum is 100,000 and the maximum is 250,000 of flood insurance needed. All right, let's see. What's the penalty for violating Ecoa?
The penalty for violating Ecoa is $10,000. $10,000. And guys, I have some extra questions for you guys. What's the penalty for sending an unauthorized fax? $500. What's the penalty for violating FCRA? FCRA, FCRA. That's $1,000. What's the penalty for violating FACTA? FACTA. That's $5,000 and or up to 1 year in jail. All right. And as we said, the penalty for violating Ecoa is up to $10,000. What's the penalty for violating Respa? That's up to $10,000 and or up to 1 year in jail. What's the penalty for violating the SAFE Act? That's $30,058. What's the penalty for violating the DNC? That's $43,280. What's the penalty for violating TILA? Kayla, the penalty for violating TILA, that's the one that has like 3 different penalties to it, right? Depending on the situation, right? There's a 5,000, a 25,000, a 1 million, you know? Yep. So what is that? Let's explain that to them. Those 3 different levels.
Well, actually another section on here that we do have, we can go into further detail with as well. We can obviously go back to that one. We can go back to that one too.
Okay.
I think that. Secondly, what are the 4 elements of a valid contract?
Okay, cool. All right, the 4 elements of a valid contract. All right, so competent parties, mutual agreement, legal object, and consideration. And here's how I think about this. I think about it like a storyline, all right? I think about it as competent parties coming together to make a mutual agreement regarding a legal object for consideration. Yeah.
Good way to remember it.
Yes. So Kayla, what is the front end and back end ratios for conventional loans?
Conventional loans is front end 28, back end 36. All right, Lance, what is the front and back end for USDA loans?
Front end 29%, back end 41%. Kayla, what is the front end and back end ratios for VA loans?
There is only a back end and it's 41. What is a front end and back end ratio for FHA loans?
31% front end and 43% back end. What is, okay, so a question for you. An applicant can request a statement of reasons within how many days of receiving the original adverse notice?
60 days. Lance, an applicant can, oh, you just asked me that, how funny. If an application for credit is denied based on the appraisal, the borrower has how many days to request a copy and the lender has how many days to deliver it?
The borrower has 90 days to request a copy and the lender has 30 days to deliver it. Yes. Question, Ecoa deals primarily with what?
Ecoa deals with primarily in credit application. What is included in the APR?
All right, so when I think about what's included in APR, I think about it this way. I think about what fees relate to the actual mortgage, right? And so I think of it that way. So the things that are included in APR are the fees that are related to the actual mortgage.
So
now, what is not included in the APR then?
So what's not included is 10x, which is a really neat way of actually memorizing it. So TENACTS. T for title insurance, E for escrow, N notary fee, A appraisal, C credit report, T termite inspection, and S seller credits. If you could memorize what is not included in the APR, then you don't need to worry about what is included, because now you know and pay attention to what's not included. Who do you give the servicing transfer statement, and how many days does the borrower have to get the payment to the right place?
15 days before the transfer, and the grace period is 60 days. Now, Kayla, Fannie Mae requires only a blank year history to be reviewed for all credit and public information.
7 years. What minimum down payment for an FHA loan if the borrower's credit score is 580 or higher?
Okay. All right. So it's 3.5%. All right. So if the borrower's credit score is 580 or higher, the minimum down payment is 3.5% for a FHA loan. But now, Kayla, if the borrower's credit score is between 500 and 579, what's their minimum down payment for FHA loan?
10%. However, if it's below 500, they're not qualified for a loan. They're not qualified because they don't show the ability to repay at all since their credit is so bad. What credit score? Oh, just kidding. I also know that it's below 500. What's the late fee for a VA loan?
4%.
Good.
What's the late fee for a FHA loan?
4%. What's late fee for a USDA loan?
4%, right? So we see a commonality. So all these government sponsored loans, their late fee is 4%, Now, what's the late fee for a conventional loan though?
5%. See, you can memorize those in increments. So 4, all those government, and then the 5 is just a separate one, the conventional. How many months of PITI payments must be verified for a loan on a non-owner occupied property?
6 months. 6 months. But Kayla, how many months of PITI payments must be verified for a loan on a owner occupied? Oh, no, I'm sorry. Yeah, on an owner occupied property. Yes.
2 months. What percentage of ownership do you need to be self-employed?
25%. 25%. Now, if the credit report does not show a required minimum payment amount, the lender should use an amount equal to what percent of the outstanding balance?
5%. Commission, overtime, bonus, and part-time income must be averaged over how many years?
2 years. Consumer debts that have less than how many months of payment remaining do not need to be included for the purpose of calculating debt ratios.
10 months. However, if there's a lease, it's always included. What is a 203B loan?
When I think 203B loan, the B makes me think about basic. And when I think about basic, I think a basic fixed rate loan, right? So a 203B is an FHA fixed rate loan. Kayla, what is a 203K loan?
203K is a rehab loan. You can think about that for thousands of dollars to rehab. 203K, thousands, it goes similar together. What is a 203G loan?
When I think about 203G loan, the G makes me think about good neighbor, good people, right? Good neighbor, good people. And so, you know, a 203G loan is a special loan for teachers, firemen, and police, right? The good neighbors. Now, what are two types of freehold estates?
Fee simple and life estates. If a consumer requests cancellation of their escrow account, the lender must deliver an escrow closing notice no later than how many days before the closure of the account?
Okay, so if the consumer requests the close, that's key. That's key to keep in mind. If the consumer requests the close, then this notice must be received at least 3 business days before the consumer's escrow account is closed. But now, Kayla, if it is closed for any other reason, right? So we just talked about how the situation if the consumer requests the close, but what about if it's closed for any other reason? When must the lender deliver an escrow closing notice?
The lender is required to provide the notice no later than 30 business days before the escrow account is closed. Key is 30 business days. Document retentions. Okay, here we go. How long do you have to retain the TILA disclosure?
2 years. But how long do you have to retain the DNC, do not call list?
2 years. How long do you have to retain the MAP, Mortgage Acts and Practice disclosures?
2 years. And how long do you have to retain the LE, the loan estimate?
3 years. How long do you have to retain the LAR, Loan Application Registry disclosure?
3 years. And how long do you have to retain the LOC?
3 years. How long do you have to retain the closing disclosure?
5 years. And how long do you have to retain the SAR, the suspicious activity reports?
5 years. How long do you have to retain the Ecoa, Equal Credit Opportunity Act disclosure?
25 months. Now, Kayla, let's explain a way in which people can memorize these document retention periods. So, but basically, there's only 4 different categories in terms of document retention, right? There's the 5-year, the 3-year, the 25 months, and the 2 years. And basically, if you memorize what must be retained for 5 years, what must be retained for 3 years, and what must be retained for 25 months, right? Then if you memorize those 3 categories, then you could just think everything else must be retained for 2 years, all right? So, Kayla, what must be retained for 5 years?
5 years is going to go ahead and be the closing disclosure, the CD, and the SAR, suspicious activity reports. Those are the only 2.
Right. Now, what about the 3-year category? What must be retained for 3 years?
The loan estimate, the LAR, and the LOC. A great way to remember this is both of them have both 3 and 3 L's. So loan estimate, LAR, and the LOC. So 3 and 3, so they go together.
Very good, very good. All right, awesome. So, oh yeah, just to recap though, you said the LE, the LOC, and the LAR, right?
Yep.
Okay, good, very good. Now, what about what's the one thing that must be retained for 25 months?
The Ecoa, Equal Credit Opportunity Disclosure.
Excellent. And then everything else must be retained for 2 years, right?
TILA, DNC, and MAP, 2 years.
Right. You know, so everything else. Excellent. So
what is, what is a warehouse funding?
Okay, so warehouse funding occurs when a lender obtains funds foreclosing from a line of credit extended by a commercial bank. And I think of that as like, when you think of the word warehouse, think commercial, think line of credit from a commercial bank. Now, Kayla, what is an estoppel letter?
An estoppel letter is a closing agent sends an estoppel letter to the seller's lender requesting the payoff amount. So it's requesting the payoff amount. Who maintains flood maps?
FEMA. What is a deed in lieu of foreclosure?
A deed in lieu foreclosure occurs when the mortgage voluntarily conveys the deed to the lender in exchange for satisfaction of the debt. The debtors still lose property, but by conveying it voluntarily before the final court action, they avoid foreclosure on credit record. The lender is not obligated to accept. What are 4 types of legal descriptions for properties?
Monument method, government land survey method, lot and block method, and the meets and bounds method. Now, Kayla, which of these 4 is the most common method?
The lot and blocks method.
And which of these 4 is the most accurate method?
Meets and bounds method. Mm-hmm. What is a CTR and who does it go to?
All right. A currency transaction report is what a CTR is, and it goes to the IRS. The Bank Secrecy Act, the BSA, and the anti-money laundering laws, right, the AML, require companies to file a currency transaction report with the IRS for cash transactions exceeding $10,000 in one day. The act requires financial institutions to keep detailed records of cash transactions exceeding $10,000. So that could be withdrawing, depositing, or transporting. Now, who is the CTR under?
The Bank Secrecy Act, the BSA, and the anti-money laundering AML. Who is the BSA and the AML under?
They're under the U.S. Patriots Act. Now, a company with which a consumer has an established business relationship, an EBR, may call for up to how many months? And what about if the consumer only inquires or submits an application?
The EBR, the established business relationship, is 18 months after the transaction date. Inquiring application, if the consumer just inquires simply, it's 3 months. So also with an established business relationship is they have to have a transaction done. They have to complete it.
Right. But now, Kayla, let's really make that really clear, though. So the overall thing is that, we must check the DNC list, the do not call list, because in general, we cannot call someone who is on the do not call list. However, if we have an established business relationship with them, then it's okay for us to call them up to 18 months, even if they're on the do not call list. And if we don't have an established business relationship with them, but if we have like a minor transaction with them, like meaning like if they submitted an application or whatever, right? Then we can call them up to 3 months. But in both cases, though, under both exceptions, if at any point they specifically tell us not to call them, then we must not call them. Right?
Mm-hmm.
Cool.
The DNC list must be updated every how many days?
Every 31 days. DNC must be retained for how long?
2 years. What is the penalty for sending authorized faxed?
$500. What is MARS, Regulation O?
MARS stands for the Mortgage Assistance Relief Services, and the MARS helps to protect distressed homeowners from foreclosure prevention scams, and it applies to negotiating, assisting borrowers with mortgage loan modifications. So basically, they can't get in the way of assisting them, pretty much. MARS has no fees are collected without what from the borrower?
No fees are collected Up front, yeah. So Mars prevents, you know, these companies from collecting upfront, you know, fees, unless there's a written agreement, like with the servicer, right? All right. So basically, what does Mars prohibit, Kayla? What are the two things?
Mars prohibits negotiators cannot interfere with communication between the borrower and the lender and cannot tell the borrower to stop paying their mortgage.
Mhm.
The lender has how many days after closing to refund the borrower any portion of the charges that exceed the acceptable amount of tolerance levels?
60 business days, 60 business days. But what about if it's for non-numerical clerical errors?
60 calendar days. TILA was implemented by who?
The Federal Reserve Board. Now, who administers TILA though?
Consumer Financial Protection Bureau, CFPB. What is loan flipping?
Loan flipping is an abusive practice in which a loan is refinanced without any tangible net benefit to the borrower. It's a form of equity stripping. Now, a creditor must respond to a payoff request within how many days?
7 days. Who took control of Fannie and Freddie Mac in 2008?
The FHFA, which stands for the Federal Housing Finance Agency. But Kayla, who allowed that to happen?
The Housing Economic Recovery Act, HERA. What is the appraisal recertification form called?
Form 442. Now, a borrower's payment history on previous mortgages and rents must be verified for how long?
12 months. What is the 8 protected classes of Ecoa? A good way to remember this is score map.
Yes, score map. Yes. So that's sex, color, national origin, race, religion, marital status, age, and public assistance. Now, we can't ask how many children a borrower has, but what can we ask?
Do you have any dependents? That is the proper way to be asking this question. You cannot ask if they are single. How do you ask?
We can ask, are you married, unmarried, or separated? Now, who enforces Ecoa?
CFPB, the Consumer Financial Protection Bureau. They're basically, again, the FBI of all mortgages, pretty much. Good way to remember that. What is a defeasance clause?
The mortgage defeasance clause requires the lender to send a satisfaction mortgage notice to the borrower within 60 days of paying off the loan. And here's a little tip. The way that I remember the defeasance clause is I think about the word defeat. So in a defeasance clause, it's like, it's a situation where the borrower has defeated the mortgage, has paid off the mortgage, and then therefore, you know, the lender is required to send the satisfaction of mortgage notice to the borrower within 60 days of paying off the loan. Now, Kayla, what is a subordination clause?
A subordination clause permits a senior mortgage to assume a junior lien position. What is escalation clause?
The mortgage escalation clause allows the lender to increase the interest rate of the loan under certain conditions. Kayla, what are the maximum seller's concessions on conventional loans? Oh, I like this question. I've been doing this question a lot in Rocky's class, right? All right, so here's the thing. I like it because it's like, I don't know, I like the system. All right, so maximum seller concessions regarding conventional loans. If the LTV is greater than 90%, then the maximum seller concession for a conventional loan is 3%. If the LTV on the conventional loan is greater than 75% up to 90%, then the maximum seller concession on that conventional loan is 6%. If the LTV is 75% or lower, then the maximum seller concession on that conventional loan is
9%.
9%. That's right. And if the property is an investment property, then the maximum seller concession is automatically what?
2%.
2%. 2%. Excellent. Excellent. All right. Now, what is the maximum seller concessions on an FHA loan?
6%. What are the maximum seller concessions on a VA loan?
4%. What are the maximum seller concessions on a USDA loan?
6%. What are two types of appraisals for VA loans?
The NOV and the CRV, which is the notice of value and the certificate of reasonable value. What is lis pendens?
A lis pendens is a notice filed by the lender when it initiates a foreclosure lawsuit. What are three common disbursements planned in a construction mortgage?
I think of this as the acronym VFW, voucher, fixed, and warrants. What is a deficiency judgment?
A deficiency judgment allows a lender to claim other assets from the borrower when the proceeds of the foreclosure sale are insufficient to satisfy the mortgage lien. What is a 5-1 arm?
A 5-1 arm has a fixed interest rate for 5 years and adjusts annually after that. What are the 4 indices?
Coffee, COSI, LIBOR, Prime. What is an FHA reverse mortgage called?
It's called a HECM, a home equity conversion mortgage.
What's the acronym?
Oh yeah, so the acronym is for HECM is home equity conversion mortgage. Right. And then
HECM.
Oh, I see. You're right. Oh, HECM. That's right. Okay, very good. I love this. HECM. That's right. Now, what does the SAFE Act stand for?
Secure and Fair Enforcement for Mortgage Licensing Act. Who enforces FACRA, Fair Credit Reporting Act?
The FTC, the Federal Trade Commission. Who enforces Ecoa?
The Consumer Financial Protection Bureau, CFPB, the FBI mortgages. Who enforces TILA, Truth in Lending Act?
The CFPB. Who enforces RESPA, the Real Estate Settlement Procedures Act?
The CFPB, Consumer Financial Protection Bureau. Previously was the HUD, Housing Urban Development. Who created the DNC? Do not call.
2 organizations, the FCC and the FTC. And the FCC stands for Federal
Commissions.
Go ahead.
Communications.
Awesome.
Federal Communications Commissions.
Right. Okay, awesome. And the FTC, Federal Trade Commission. Excellent. Now, who implemented TILA?
The FRB, Federal Reserve Board. Who implemented HMDA, HMDA?
Also the Federal Reserve Board. Who created red flag rules?
The FTC, Federal Trade Commission, and the FACTA, FACTA. What is the Irs Form 8821?
The Tax Information Authorization Form. What is the 4506T form?
Request for transcript of tax returns. What is a qualified written request?
A qualified written request, a QWR, it's where the homeowners who are having issues with their mortgage servicers may take advantage of a provision of Respa whereby a borrower may request information relating to the servicing of a loan. It is called a qualified written request, or QWR, and it imposes a duty to respond to the borrower's inquiries. A qualified written request, a QWR, requires that the lender acknowledge receipt of the request within 5 business days and seek to resolve the issue or concern within 30 days, with a 15-day extension if needed, if the issue is in connection to notices of error submitted by the borrower. Now, what is a HCML?
So first, to determine a high cost mortgage loan, or secondly, a high priced mortgage loan, would be if the loan, the APR being offered meets the client's compared APOR, and if it meets a certain thresholds of a high cost loan. So with that being said, let me pull up some notes that I have on here. So for a high cost loan, an HCML, section 32 is going to be 6.5% of the first loan lien over 50,000 or over. 6.5. Second is going to be 8.5 first loan lien under 50,000. And then 8.5 is second subordination and junior lien. 8.5. And
right, now, just to clarify though, when you get into these percentages, what do those percentages mean? It means that it's the rate is those percentages that are above the APOR.
Yes. If they are above the APOR, correct. Yep. The APR is above the APOR. And for the first, if you want to make some notes too, so 6.5, the first loan over 50,000 or more. 8.5, first loan lien under 50,000. And 8.5 is the second subordination in junior lien. Those are the percentages for the first and second as well. And fees on loans over 22,052 is 5% above. And fees on loans under 22,052 is 8% above. So those are some little facts that we do have about high cost. Can you tell me a little bit about the HPML for the high price?
No, wait, before we move off of the high cost, also though, there's some restrictions that we should explain. Well, what are the restrictions?
So a good way to remember this is FAB, P-H-A-B. So no prepayment penalty, a HUD counseling is mandatory, and the prove ability to repay, and no balloon payments. So those are 4 things that is involved for a high cost.
Oh, I like that acronym. What was that acronym you said?
P-H-A-B, FAB, P-H-A-B.
Oh, okay, I like that. Okay, because I've seen another acronym, just to give them another acronym, is PAPS. B, no balloon. A, must have the ability to repay. P, no prepayment penalty. And S, must speak to a HUD counselor, right? Now, now between this acronym and the acronym you read, is that like the same? It's just
they're the same.
But they're the same.
Yep. They're literally the same, just with different letters. Different letters. Good. Crazy. Good. Whatever sticks in people's mind.
Right. Exactly. Okay, cool.
Okay, let's see. All right, you tell me a little bit more about a high price.
Okay, so now a high price mortgage loan is a section 35 loan. And so, okay, so a loan will be considered a high price section 35 loan if its APR exceeds the APOR by more than 1.5% on a regular first lien loan, or if it exceeds 2.5% for a jumbo first lien loan, or 3.5% for a subordinate lien loan, right? Now, Section 35 high price loans require the following, all right? And when you think about what they require, think about it in terms of this acronym APE, all right? So it requires that We have the A, meaning the ability to repay. The P, meaning no prepayment penalty unless it's for the first 2 years, right? So that's an exception. No prepayment penalty unless it's for the first 2 years. And the E is escrow account, must have an escrow account for the first 5 years, Excellent. I think that covered all of section 35. So, okay. So now,
Also,
go ahead.
so what helps for section 35 for people to remember how it's, it's 1.5, 2.5, 3.5. It's, you can literally remember 1, 2, 3, and there's a 0.5 just with all of them. 1.5 first, 2.5 jumbo, 3.5 second. So 1, 2, 3.
I like that. Excellent. I like that. All right. And now, what is another name for the GLB Act?
Another name for the GLBA is the Graham-Leach-Bliley Act. Another name for it is going to be the Financial Service Modernization Act of 1999. So the acronym is GLB, and GLBA is the Graham-Leach-Bliley Act. Another name, again, Financial Service Modernization Act of 1999. Under FACRA FCRA, when can you receive a free copy of your credit report?
This is a good question. And now here's the thing. There are 2 regulations that under which you can get a free credit, a free copy. You can get a free copy of your credit report. Now, here's the thing. There's FACRA and there's FACTA. Now, under FACRA, there are 5 reasons why you can get a free copy of your credit report. And that is you received an adverse action.
Yes.
You are on public assistance. You are unemployed. You have experienced like errors in your credit report errors, or you have been the victim of fraud, right? So those are the 5 reasons under FACRA. But now, Kayla, under FACTA, when can a person receive a free copy of their credit report? Under FACTA, they can receive it once per year.
Yes.
Right?
Yes.
Right, under FACTA, once per year. Now, what is the website, right, that FACTA recommends? It's www.annualcreditreport.com. Yes. Very good, awesome. So now, TILA applies to credit transactions payable in how many installments?
More than 4 installments. How many pages is a closing disclosure?
The closing disclosure is 5 pages long. And the way that I remember that is because we must keep the closing disclosure for 5 years. And so it's also a document that's 5 pages long. Now, Kayla, how many pages is the LE?
LE is 3 pages, and how you can remember it, it's 3 years document retention time and 3 years copy of the loan estimate. So 3 and 3 go together, just like the closing disclosure, 5 and 5. What is a penalty for violating GLB?
Up to 5 years in jail and a fine. What is a temporary 2-1 buy down?
A buy down allows a purchase to reduce the interest rate on a mortgage by 2% for the first year and 1% for the next year, and it remains the original rate every year after. What is a suit of quiet title?
A suit of quiet title, also known as a quiet title action, is used to remove a cloud on a title. What is a chain of title?
A chain of title is a clear, unbroken chronological record of ownership of a specific piece of property. So basically, it gives you the entire history of a certain property. If you could go on to First American or any title company, you could literally see the exact chain of who were the previous owners throughout that timeline, and that's going to be a chain of title. What is functional obsolescence?
Functional obsolescence is caused by a change in buyer's tastes. What is color of title?
Color title is appears of having title to personal or real property by some type of evidence. But in reality, there is either no title or it's defective title. This person is usually not the actual title owner. What are trust deeds?
Okay, so trust deeds are instruments placing specific financial interests in title to real property into the hands of disinterested third party as security for payment of the notes. So just to clarify, the borrower is the trustor. The lender is the beneficiary who retains notes and deed of trust, and the trustee holds legal title to security property described in deed of trust, subject to terms of trust for lender benefits. All right, so now mortgages. So Kayla, mortgages have judicial foreclosure and require court action to foreclose on a property. But what about trust deeds?
Trust deeds are non-judicial. And how to remember this is that they do not require a court action to foreclosure on a property. So think about non-judicial, no court. Judicial, court, you need to go. So non-judicial, you don't need to have that party there. They don't require a court action. You can just sell it. That's just a one implement way to remember it.
Mm-hmm.
What is the 1003?
The 1003 is the URLA.
There you go.
Uniform Residential Loan Application. Yes. Now, what is the 1004?
Appraisal. 1005?
The 1005 is the VOE, the verification of employment or verification of payroll, you might see it as. What is the 1006?
Verification of deposits.
Mm-hmm.
What was the 1007?
The 1007 is verification of rents. What is the 1008?
Transmittal summary.
Mm-hmm.
1009?
1009 is reverse mortgage. What is Form 442?
A recertification of an appraisal. Good job, Lance. You killed it on that one. Good job.
Mm-hmm.
What are the 5 C's of underwriting?
All right, 5 C's of underwriting: capacity, capital, credit, collateral, and character. What are the 6 items that make a complete application?
Good way to remember this is aliens. So address, loan amount, income, estimated value, name, social security, number. Those are the best ways to remember that makes 6 requirements for a completed application. And then that's when you have to send out, the disclosures of 3 days in the timeline period. But yes, those 6 items do make that complete application.
Yes. And now, just to clarify, when you say number, what do you mean by number?
By number, I mean phone number.
Phone number, right? Yeah, I'm pretty sure that's phone number. Yeah.
What is?
Wait, is that? Wait a minute. Hold on. Wait.
Oh.
Okay.
I lied. That was the test. That was a test.
Yeah, that was a test. Okay, so Kayla, what are the 6 items that make a complete application?
The 6 items that make a complete application, and the best way to remember this is aliens. ALIENS. Address, loan amount, income, estimated value, name, social security. There we go. We got it. What is equitable right of redemption?
The equitable right of redemption allows the mortgagor in default to pay the entire balance due and keep the property from being foreclosed. What is table funding?
Table funding is a process that allows a broker to originate and close a loan under his or her name. After closing, the mortgage and note are immediately assigned to that investor. What is a direct investor?
Direct investor funding occurs when the lender deals directly with the borrower without any middlemen.
Middleman as in the no broker, pretty much, no mortgage.
Good point. Good point.
What is
warehouse funding?
warehouse funding occurs when a lender obtains funds for closing from a line of credit extended by a commercial bank. What is a builder bailout scheme?
A builder bailout scheme can occur when a builder or developer experiences difficulty selling his or her inventory and resorts to using fraudulent means to unload properties.
What is dual tracking?
Now, dual tracking, Respa Section 6 prohibits dual tracking, which is continuing to seek foreclosure actions while the borrower is being considered for other workout options. Now, what are the 3 types of caps on ARMs?
Initial, periodic, and lifetime. What is an alienation clause?
The mortgage alienation clause is a provision in a mortgage enabling a lender to demand full repayment if the borrower transfers the loan. What is Escupletory clause?
The mortgage exculpatory clause prevents the lender from requesting a deficiency judgment against the borrower when the proceeds of the foreclosure are insufficient to pay off the mortgage lien. Who created the SAFE Act?
The SAFE Act is part of the Housing and Economic Recovery Act, HERA, of 2008. Who created the CFPB?
Consumer Financial Protection Bureau, CFPB, was created by the Dodd-Frank Act and the Consumer Finance Protection Act. What does Respa cover?
Respa covers 1 to 4 unit residential property. When do you give the initial escrow statement?
Usually given at settlement, but lender has 45 days from settlement to deliver, sometimes referred to as the hello letter. Who enforces FACRA?
FACRA, FCRA, right? The Fair Credit Reporting Act is enforced by the FTC, the Federal Trade Commission. What does TRID not apply to?
TRID does not apply to all cash sales, HELOCs, reverse mortgages, and mortgage for mobile homes not securing by real estate.
Right. Now, well, what's a way to kind of help people memorize what TRID does not apply to? Well, TRID is about, like, one of the main things about TRID was that it combined, certain documents together to create the LE, the loan estimate, and the CD, the closing disclosure. And so therefore, any transaction that does not get the loan estimate or the closing disclosure does not relate to TRID. So therefore, if it's an all cash sale, well, if it's all cash sale, there's no loan at all. And so you're not going to get the LE or the CD. So that doesn't relate to TRID. If it's a HELOC, if it's a reverse mortgage, if it's a mortgage for a mobile home not secured by real estate, those things don't get the LE or the CD. And so therefore, TRID does not apply to those transactions. So that's good.
That's an amazing way to remember that. That is a great way, actually. That's very good that you inputted that for everyone.
Mm-hmm.
What is a simultaneous issue?
Issuing both the homeowners and the lender's title policy at the same time is called simultaneous issue. Who is the guarantor?
The guarantor is the grantor, is the owner of the property. So a good way to remember this is grantor, owner. That's a great read.
I like that. Awesome.
What is HVCC?
The HVCC is the Home Valuation Code of Conduct, and it prevents a mortgage broker from choosing the appraisal, from choosing the appraiser for loans that are sold to Fannie Mae. So, and actually, the Dodd-Frank Act extended the law to include all mortgages. So therefore, the HVCC prevents a mortgage broker from choosing the appraiser for all mortgages, for any type of mortgage. Yeah. Awesome, awesome, awesome. So now let's jump into some extra questions, all right? So guys, I hope you guys are having a good time so far with our, this pop quiz. So now we're just gonna make up some random questions from another study guide. So, okay, what is the CRA?
The Community Reinvestment Act, CRA. That's a good one to remember.
And the CRA, it requires the Federal Reserve and other banking regulators to encourage financial institutions to help meet the credit needs of communities in which they do business. And also, it includes low and moderate income neighborhoods, right? So they're really focusing on low and moderate income neighborhoods. So that's good.
Which makes sense. It totally makes sense.
Right.
So tell me about the ability to repay. MICE does have the ability to repay. That's a great way to remember this.
Yes. Okay, good. Now, are you going off of this study guide, or how are you going? Like this?
Oh, I have it. I am not going off that study guide. I'm going off that one in front of you. The whiteboard one.
This one right here, the board. Oh yeah, good. Yeah, okay, yeah. Let's do that, and then we'll jump into the study guide. Okay. All right. So the ability to repay. Yes. So guys. So remember how in the Section 32 loan and the Section 35 loan, one of the requirements of those loans is that the borrower must have the ability to repay, right? Also, too, very big thing about qualified mortgages, though, too, right? That also has that requirement for the ability to repay, right? So what is the ability to repay? Well, when we are evaluating a borrower's ability to repay, we're going to be looking at these items, these 8 items, all right? We're going to look at it's called MICE does. So the M is
monthly payment.
Yes. The I is
income and assets.
The C is
credit.
The E is
employment.
The D,
debt to income.
O,
other debt.
E,
expenses.
And we say expenses, what do we mean by expenses? Like what? Insurance, right?
Your monthly housing payment, PIT.
Yes, very good. And then S.
Simultaneous mortgage, so another debt or another mortgage you have, like a HELOC or another property, another kind of mortgage.
Yes, and remember, Kayla, you mentioned that these things also relate directly to the 1003, right?
Yes, they all relate. I mean, if you're gonna, it's like 6 items to complete a loan application in a way. So, I mean, you need to know the monthly payment, income, credit, employment, debt, DTI, and other debt, expenses, and other mortgages. It's like the same thing when you qualify them. When you qualify the borrower, ability to repay, you need to look at the same thing.
Very
It's
good.
a way to implement them together.
Yeah, very good. Let's talk about the tolerances. The tolerances, right? So there's 3 categories, right? There's certain fees that have a 0% tolerance. Then there's certain fees that have a 10% tolerance. And then there's certain fees that have no tolerance at all, meaning that, it can, the amount can change and there's no limit to the amount that it can change by, right? So let's first talk about the items that have a 0% tolerance, meaning that they cannot change.
A good way to remember the 0 tolerance is trail, TRAIL. So trail would be the transfer of taxes, R, report, the credit report, A, appraisal, I, interest rate, L, loan origination. That is what the borrower cannot shop for. That's going to be trail.
Very good. What about what are the items that are under the 10% tolerance?
The 10% is going to be the government recording fees, the title insurance on the lender's list, or anything that is chosen off the lender's list.
Very good, very good. All right, and then what are the items that have no tolerance at all?
No tolerance is hazard insurance, termite inspection, title insurance, and per diem fees prepaid on mortgage interest.
Okay, awesome. So,
Yeah,
go ahead. Say that again. Okay.
I think those are like the three things for zero tolerance, 10%, and the no tolerance.
Yes, very good, very good. I guess a major item under the no tolerance is like stuff where the borrower like chooses their own provider, right, and not choosing off of the list, right? Because I mean, I guess one distinction is that if the borrower chooses off of the lender's list, it's going to be a 10%. But if the borrower decides not to choose from the lender's list and chooses outside the lender's list, then that's going to be like a no tolerance. But now that, in general, right?
Also, with exceeding the tolerance amounts,
Yes.
The creditor has to pay back any overages and within 60 business days, giving a new closing disclosure with the corrected information within 60 calendar days.
Yeah.
So to pay back the overages within 60 business days and give the closing disclosure within new information that is updated within 60 calendar days.
Yes, very good, very good. Good point, good point. Awesome, awesome. What about flood zones?
Ooh, flood zone. So there's a high risk, moderate, and what was the last one? A low risk. So for the high risk zones A and V, insurance is mandatory since they are high risk. Moderate zones would be B and X. Insurance is optional. Low risk is zone C and X. It's not required. And the minimum and the maximum amount for flood zones is $100,000 and $250,000.
Very good, very good. Yes, yeah.
Right. So then let's look into Brawl. Let's remember what Brawl was. Brawl CCT was the TILA disclosures.
Yeah.
The TILA disclosures. So I could go through these as well too.
Yeah, let's do it. Let's do it. Tag team. Yeah.
So TILA disclosures, Brawl, BRAWL. CCT, Brawl on closed caption TV. Great way to remember this is the disclosures. So B, balloon notice. R, right to rescission. A refinance home improvement loan, a HELOC, or a second mortgage. Those all have the right to rescission because they are owner occupied. ARM disclosure. W, when your home is on the line. L, loan estimate. C, charm booklet. C, CD, and T, transfer a mortgage notice.
Yeah.
So those are all great ways to remember Brawl.
Yes. Oh, and I was thinking about transfer a mortgage notice. I was thinking about a question where it's like they say, when must the transfer of mortgage notice be given? And that's within a certain amount of time after the acquisition. We must give the certain
30 days.
30 days. Okay, so within 30 days of the acquisition of like the new owner of the
ownership. Yeah. Transferring the mortgage.
And by the way, this is the transfer of the mortgage. This is not to be confused with the transfer of the servicing, right? This is the transfer of the mortgage, right?
The ownership, yeah. This is the mortgage notice. So this is the ownership transfer.
Ownership, right. So that's a good distinction. If we're transferring the ownership of the mortgage, then we have 30 days from the transfer to notify the borrower, right? But what about this? What if we're transferring the servicing? When must we notify the borrower regarding the transfer of servicing? That we have to notify them 15 days prior, right, to the transfer. And we give them a grace period of 60 days to get it to the payments to the right place, right?
Yes.
Yeah. Very good. Cool. All right.
Good job. Look at you. Killing it.
Yeah. Good teamwork. Yeah. Respa disclosures. What are the Respa disclosures? Love the acronyms. We have Camilas. The K is the know before you owe, right? Booklet, right?
A will be the AFBA, the affiliate business arrangement disclosure.
Right.
And mortgage servicing disclosure statement.
Servicing.
Lender intentions. I, initial escrow. L, list of HUD approved counselors, 10 of them. A, annual escrow. S, servicing transfer disclosure. And that needs to be 15 days prior to transfer and 60-day grace period where that does not ding their credit and there's no late fee.
Mm-hmm. Yeah, wait, no, okay, so wait, the S is the servicing transfer disclosure, right? What's the M? What's the M again?
Okay, mortgaging servicing disclosure statements, the lender's intentions.
The intentions, okay, yeah. I think a lot of people get confused by that. So the mortgage servicing disclosure, that's given within 3, it's one of the initial disclosures, right? It's given within 3 business days, 3 days of the completed application, right? Okay,
Yes.
good. Okay, but then this servicing transfer statement, that's where it's given like 15 days before the transfer and then 60-day
grace period.
yes. Okay, so just wanted to point that out. That's a common mistake. Okay. All right, and then also, so in addition to Camila's, we have 2 other Respa disclosures, right?
Mm-hmm. So we also have
good faith estimate.
the good faith estimate and the HUD, and that's for non-purchases. So that's for like reverse mortgages.
That's right. By the way, speaking of the good faith estimate and the HUD, right? So TRID did what? TRID combined what 2 documents to create the loan estimate? They combined the good faith estimate and
HUD 1 settlement statement.
The initial till?
The good faith estimate.
The initial till? The initial till.
The initial, I think it was where HUD 1 transfer statement.
So TRID combined the GFE and the initial till to create the loan estimate. And then also TRID combined the HUD 1 and the final till to create the closing disclosure.
There you go.
Yeah, that's what that is. Yeah. Okay. All right. Awesome. What about NMLS number? Our NMLS number will go on what documents?
Your unique identifier number is going to go on the 1003, the Uniform Residential Loan Application, the promissory note, mortgages, advertisements, and trust deeds. There's 5 items where it will be on.
Yes. Very good. Now, a big thing is about Ecoa, the protected classes of Ecoa and the protected classes of fair housing, because there's certain protected classes that fall under both categories, but then there's other protected classes that only are under Ecoa and some are only under Fair Housing Act. So what are the protected classes that fall under both Ecoa and Fair Housing Act?
So a good way to remember this is SCORR. It goes for both of them. So SCORR, sex, color, origin, national origin, race, and religion. And those are the ones that go under that goes under Ecoa and Fair Housing Act. They go together. So also to separate them, what goes under Ecoa as well is maps too. So SCORR maps, marital status, age, and public assistance. Map.
Only under Ecoa. Map only goes under Ecoa. Right. Okay, good. Very good. And what only goes under Fair Housing Act?
Fair Housing Act is going to be the familial status, and it's going to be handicap, disability. Good way to remember that. So FH and MAP. FH is FHA, Fair Housing Act, and Ecoa, MAPS.
Very good.
Different ones. Yep. So we got that one done. Good job. What does GLBA have? There's 3 things.
Yes. It has SPF. And it's kind of like, you know how SPF is like for sunscreen, like sunscreen protects us from SPF. So yeah, GLB, Gram Leach Biley has SPF. That's safeguarding, protecting, and financial privacy.
Yep. You got them. You got them. Secondly, also with Respa too, Respa has sections, right? So SCATE, like you mentioned, that's a great acronym that we have. Let's go through what SCATE means. So SCATE, S, mortgage servicing and abuse, section 6. K is going to be section 8, kickbacks, fee splitting and unearned fees. Section 9, T will be for title times 3 treble damages. To remember that the buyer can sue the seller for 3 times the amount for title insurance because the borrower is not required to use not required to use the title insurance the seller request. They can pick their own. And then E, escrow, is going to be the annual escrow analysis, section 10.
Very good, very good. What is the MCR? MCR, what does the MCR stand for?
Mortgage call reports.
Yes, mortgage call report. And what are the 2 sections of the MCR? There's the residential mortgage loan activity report, and there's the financial condition report. 2 sections of the MCR. And here's the thing to note is that regarding the residential mortgage loan activity report, they are completed quarterly within 45 days of the end of the calendar quarter. And the financial condition report is completed annually within 90 days of the company's fiscal year end. And regarding the MCR, right? So those 2 are just sections of the MCR. Regarding the MCR itself, it is a quarterly report of the condition of the business that an entity submits through the NMLS. So that's cool.
There you go. Good job. Good job.
Yeah.
Perfect.
All right. So let's see. Okay, so AUS systems, automated underwriting systems. Fannie Mae uses what automated underwriting system?
DU, desktop underwriter.
Freddie Mac uses what?
LPA, loan product advisor.
And FHA uses what?
Ooh, FHA uses
Total scorecard. Total scorecard.
Total scorecard. Well, that means the entire credit report. I'm pretty sure. No, not the credit report. Total scorecard. Okay, that makes sense.
Yeah, total scorecard. All right. And let's see. Did we cover? I think we covered this whole board. Yeah. Okay.
You did a great job. You've definitely mastered it.
Thank you. You too. You too. Good teamwork. Good teamwork. Excellent. Excellent. All right. So we'll just roll through this study guide. All right. So APR. All right. APR versus the note rate. So what's the distinction between the APR, the effective rate, versus the note rate, the interest rate?
Hold on 1 second.
Sure. Yeah.
Okay, so the APR is a relationship between the total cost of borrowing and the actual amount borrowed. APR includes interest rate, any points, mortgage broker fees, and any charges to get the loan. Interest rate, note rate, is the cost you pay for each year to borrow money, expressed as percentage rate. Interest rate is used to amortize the loan and determine monthly loan payments. So that is the difference between the APR and the interest rate. We've gone through the back end ratios. Oh, we have not gone through the back end ratios. That's a very important part too. Oh no, I'm just kidding. We have gone through that.
Yeah, we did, right? We did that. Yeah. Okay. Cool. Okay, so
FACRA, Fair Credit Reporting Act. We've done a few of these. What is the goal?
The goal is to regulate collection, use, and dissemination of consumer credit information. Must be fair, accurate, and private about the use of this non-public information, right? So, we enforce, FACRA is enforced and overseen by the Federal Trade Commission and the CFPB. It limits, FACRA limits on what can get access to credit report of consumer. Right?
Limits who can get access to the credit report of the consumer. So basically it's not anybody can just get access to it. It's they have to have a reason to have access to the credit report.
Right, yes. Now, what's this about the adverse? Oh, I see. So the right, so it has, so some features, right, of the Fair Credit Reporting Act, right, is adverse. So what is that about? The right to get adverse action notice.
So basically, if you deny the loan, you have to provide the borrower why you denied the loan. So it's info on the, credit reporting agency, who the credit reporting agency is, the reason for the denial, the credit score, the range used, and the date of the credit report. And so with that being said, the report, the consumer has the right to get the copy of the credit report. Meaning the adverse, identity theft, fraud, public assistance, or if they're unemployed within 60 days to being unemployed, they can all receive the right to get the credit report. The score they can request it, of course, but it's not free. You do have to pay for that. They can have the right to dispute any negative information on the credit report. And they do have the right to limit any pre-screened offers. So those are people that basically send mail to your house all the time. And, it's like we have not ran your credit, but we see that you're like pre-approved for this amount. That's a pre-screen offer.
Yeah. So
we definitely have covered a lot of this. So I think
we've covered, so FACTA, we've covered Graham Leach Biley, we've covered the safeguard rule, right? Just to kind of call them out. The right to rescission, right? We kind of talked about that. There's a 3-day right to rescission, right? Now, regarding the 3-day right to rescission, when does it expire? It expires on the 3rd day, but the first day is not like the first day. You know what I'm saying? So like, for example, okay, let's do it. Suppose it's Monday, right? When it's signed, right? Okay. Then when will the right to rescission expire? Well, the first day will be Tuesday, Wednesday, Thursday. At midnight on the 3rd day would be the time that it expires, So
yes, that is when the adverse, that was I'm sorry.
It's about the right to rescission. Right to rescission.
For the right to rescission. It's on the 3rd business day on midnight.
Right, 3rd business day. But the first day is not the day that, you know what I'm saying? First day is the next day.
First day is not counted. It's going to be the 2nd day. So if it's issued on, it's delivered on or sent out on a Monday, it goes Tuesday, Wednesday, Thursday. Tuesday, Wednesday, Thursday. Midnight of Thursday is when that is the last 3rd day.
Right,
So
right. Now, so 3 days after closing. Now, but okay, now we exclude Sunday and holidays, right? Because we're going with the business days, right? The definition.
Unless the credit, yes, exclude Sunday and holidays. It's only open if the agency is open to the public, pretty much.
Okay, so now, that's a good exception to talk about. Now, when it relates to the LE, when it relates to the LE, it's how the initial disclosure, the LE has to be given within 3 days of the completed application. Well, when we count 3 days regarding that situation, it's 3 days that the business that the business is open, right? So that could even include Sunday if Sunday is open.
It just depends on the company if it's open or not. That's really ultimately when it depends. So usually it's always in general it's always pretty much excluding Sundays and federal holidays. But if it's open to the public, yes, it's counted.
Right. Now, but this only applies to the LE though, right? It doesn't really apply to, or does it apply? It might apply to the right, and that's something we have to look. The way I learned it was applied to the LE.
Yes.
Okay.
There's several. We can look at it.
Okay, we can look at that later. Okay. All right. We'll make a note and look at it later. Okay. All right. So that's right of rescissions. All right. So just calling out just main things. All right. So the DNC, we kind of went over that. The Homeowners Protection Act, the HPA. Okay, so yeah, here's the thing. Homeowners Protection Act. What's the main purpose of the Homeowners Protection Act? It deals with what? It deals with the PMI, right? The private mortgage insurance. It's the act that talks about how, you know, if the down payment is lower than 20%, then, you know, PMI is involved regarding conventional loans.
So with conventional loans, if the PMI is above, you know, 80% loan to value, so you would require private mortgage insurance. 80% LTV is the same thing as 20% down. It just looked at differently.
Right.
And so it'll be required on conventional loans, anything with anything higher than 80%. I'm sorry, anything lower than 80% loan to value, anything less than 20% down will be required private mortgage insurance.
Right. Very good. Very good. Very good. Yeah. Same. We talked about that. And
when can the borrower request the private mortgage insurance to come off? It can request to come off when the LTV is at 80% as well.
That's right. That's right. And it automatically has to come off when the LTV reaches
78.
82. Wait, 78. Yeah. So, okay.
78%. You probably
78. Because yeah, it's the flip of like the equity. I'm thinking about equity, right, and all that, right? So like 22% equity, right, and then 78% means 78% LTV, right. Very good. All right, Mars, Mortgage Assistance Relief Services, right? That's with the foreclosure prevention scams, right?
Preventing scams.
Right.
You know, we've done the appraisals, we've covered that, the Uniform Residential Appraisal Report. It's valid for 6 months, must be certified if 4 months old at closing. We've covered that as well. So there's also 3 approaches for.
Which page are you on?
I'm glancing through the pages.
Oh, you're going, okay.
I'm just putting some information that should be just mentioned.
Oh, gotcha. Okay, so, no, I'm just trying to track you. Okay, that's all. Yeah, okay.
There's 3 approaches for appraisals. The sales comparison approach, that's 3 comps going back, and it's for residential and vacant land. The cost replacement approach for new construction loans and special purposes. Income capitalization for store and commercial apartments. So those are the 3 types of approaches for appraisals: sales, cost, and income approach.
Yes. Very good.
We've covered honestly a lot of this, what I'm looking at.
Yeah, okay.
Let's talk about too as well the steps to get licensed. The number 1 thing is to get a NMLS number, the unique identifying number. Secondly is the 20-hour course, the pre-licensing. Number 3, third step is the exam. You got to take the Uniform State exam. 4, the MU4 application. And 5, fingerprints. And 6, the credit report. So those are all 6 steps to get licensed. That's what you do prior to taking get licensed.
Here's a big thing. So there's the 20-hour, right? And then there's the 8-hour of continuing, right? So we have to do a mandatory 20-hour. Now, regarding the mandatory 20-hour, right? I know that at least 3 of those hours are federal law.
Yeah.
Right? And then
3 hours federal law, 2 hours ethics, 2 hours non-traditional mortgage, 2 hours non-traditional mortgage, and 1 hour elective. For the
20-hour.
Yep. Oh no, I'm sorry. That's for the 8-hour continuing education.
Right. 8-hour continuing education. Right. Okay. So that's the 8-hour. 3, 2, 2, and then 1. Right.
3, 2, 2, 1.
Okay, but then for the 20-hour, it's still the same 3-hour federal law. But here's the thing: for the 20-hour, the ethics is 3 hours instead of 2 hours.
Yes.
Right. So the ethics changes. For the 2 hours, 3 hours, and then it's 2 hours.
3 hours federal law, 3 hours ethics. Then I think it was 2 hours non-traditional.
And then electives, right?
Yes.
Okay. Very good.
Wow. I mean, honestly, we've covered such a great amount of it. I think what we'll do in the next video, we can start covering some of the acronyms that we can go through again, and Ecoa, we can go into detail as well. We can go to all sorts that we have on here.
You're right. Awesome, awesome, awesome. Very good. Excellent. Thank you, Kayla. This has been awesome. Awesome.
Thank you. You've done such a great job.
And so, guys, connect with us. We're part of this great group on Facebook, all right? Where we have like the cheat sheets, and we have like study guides, and there's a guy named Rocky that does like these study groups during the week, you know, and everything. So connect with us. Our videos are posted on the Facebook. So to connect with me on Facebook, just search Lance Clay Smile Smith, right? Lance Clay Smile Smith. You'll connect with me, and I can give you like, you know, copies of like these printouts and stuff. I mean, copies of like the board and stuff, and also connect you with our study group that's on Facebook. All right. So if you have any questions or comments, leave them in the chat box below, and we will see you next time on the next video.
Bye, guys. Thanks, Lance.